Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an esteemed economist with an impressive track record, a regular contributor to many major financial publications and television programs, and the founder of Rosenberg Research and Associates. It's David Rosenberg. It's an honor to have you on the show.
And it's an honor to be invited, so thank you.
Fantastic. Well, I want to get started with a tweet that you made recently where you said valuation, sentiment, and complacency are simply off the charts. Capital preservation is of no interest to anyone these days. Time to dust off the Charles Mackay 1841 classic, Extraordinarily Popular Delusions and the Madness of Crowds. You followed up with inflation phobes take note. It's only $17 on Amazon. So I'd like you to expand on those thoughts for us, because I'm seeing what I can only call a lack of sanity in markets today. We're seeing crazy things happen, like a man named Roaring Kitty posting a meme on Twitter causing GameStop to pump. We're seeing meme coins everywhere. I don't know what the fascination is there. When it comes to the broad market, Nvidia is a real company, unlike meme coins, but some would argue that it has risen to insane valuation levels. What are your thoughts? How can investors make sense of all of this?
Well, you hear a lot of the time that this is a liquidity driven market, but yet nobody ever really manages to define what exactly is liquidity. And it's a euphemism for animal spirits, for confidence. It's the bid-ask spread. That's what it is, and there's tremendous confidence. I think that you could boil it down to two things. First is that everybody seems to believe that the business cycle's been repealed, that there is no recession. And the reality is that if you don't have a recession, you don't have a fundamental bear market. And everybody and their mother has thrown the recession call into the dustbin, and they believe either that there's a soft landing or there's a no landing. The economy is just never going to land. So that's been part of the narrative that has spurred on this tremendous sentiment that is bordering on complacency and probably even more than that. You also hear that this has been an earnings-driven market rally. I'm talking about in equities. And yes, with the first quarter numbers pretty well in, the year-over-year growth in S&P 500 earnings per share is running around 6%. If the market was up 6%, I'd go, okay, yeah, I would define that as an earnings-driven rally. Earnings up 6%, market up 6%. But heading into this very recent correction phase, the market was up almost 30%. You had basically the price action in the S&P 500 running 6 times what the earnings stream was actually delivering. And people will then say, well, but expectations of the future are so much brighter because of AI. And I want to just address that, because what's interesting is that if you go all the way out to 2027, where we could get the data, there's been no movement. I mean, since the NVIDIA blowout from over a year ago, and this whole AI craze and the ramping out of orders and spending and so on and so forth, that the earnings estimates out for the next 3 years plus haven't budged. And when you look at the overall S&P 500, so let's take a look at the overall market. There's been absolutely no change. Since the market hit its nearby low last October, the consensus earnings outlook for 2024 hasn't moved a penny. And the 2025 outlook has gone up the grand total of 2%. So what we're left with here is a forward multiple. And I admit that valuations are not a timing tool, but they do provide you with a window as to whether or not you have a headwind or tailwind at your back. So it acts as a constraint on future expected returns, even if it's not a timing device. And the multiple since last October to current, the forward multiple has gone from 18 to 21. 21. This is the top 10% decile. It's the top decile. I guess 10% and decile are the same thing. It's the top 10% most expensive stock market of all time. And a 3-point multiple expansion in a 7-month time span. I mean, hello, 3 points in 7 months classifies as a 2 standard deviation event. Now you can get 2 standard deviation events at lows, like we had in March of 09 when it's telling you jump in. And then you can have 2 standard deviation events on the other extreme when you have multiples at these levels. And it's saying either get out of Dodge, or if you are in love with your equity portfolio, at least have the discipline to sell some call options against that. And that comes down to the capital preservation. Protect your downside at market peaks. Doesn't hurt.
Yeah, no, that makes a lot of sense. So would you say at this point in time, it makes sense for people to be keeping dry powder on the sidelines, to be parking cash in things like short-term treasuries, money market accounts, etc.? At least don't be all in on the market at this point.
Absolutely, especially now that cash is no longer trash. This isn't 2 years ago when you're earning 0 on your T-bills in your money market. Now you can pick up a treasury bill yield at 5.5%. So you see you're getting paid to wait. And this is just the nature of cycles. We get excessive fear, and we've seen that before. And we get excessive greed, and we're seeing that now. And these are the primal emotions that drive the stock market. The stock market is always a very interesting asset class because it's investing in the future. It's investing in ingenuity and innovation, and it's very sexy. You don't go to cocktail parties where people talk about gold and silver or the treasury market. Of course, they might talk about Bitcoin because the more juice something has, the more topical and interesting it becomes. And so the stock market is always interesting in both directions, and it's always topical, and it's what we always like to talk about. But I would say that we are going to head into an environment where the weak hands will be forced to sell to the strong hands, and the strongest hands will be the ones that have, you call, dry powder, and yes, the ones that have real liquidity, cash on hand, are going to be the big beneficiaries if you're willing to have a 12 and 24-month view. The cycle is going to turn because the cycle always turns. If you have a 10, 20, 30-year view and you're just strictly long-term buy and hold, then nothing that I'm saying is going to help you. You just want to stay balls to the wall bullish on equities to perpetuity. However, if you do invest around the cycle, we are at the peak. And having cash on hand to buy these assets at more appropriate levels. Like appropriate levels means what? The equity risk premium is almost down to 0. Normally, you get paid 300 basis points to be in the stock market because it's riskier than the bond market. The bond market has risk. I'm talking about the government bond market. There's inflation risk, there's duration risk, but there is no capital risk. But there is capital risk in the stock market, and it is inherently more volatile. So traditionally, equity investors will demand in normal times at least a 300 basis point premium in terms of what the earnings yield is, which is the inverse of the PE, compared to what the comparable yield is, say, on the 10-year Treasury note. That relationship is almost close to zero, which means what? It means you are not being compensated for equity risk. As a stockholder right now, this doesn't apply company to company or even subsector, sector to sector. It's really about the overall stock market. I would prefer to be paid to take on the risk, to own the equity market, as opposed to what's happening right now, which is people willingly and blindly buying the stock market, but not getting paid. They are paying for the equity risk, which makes no sense to me. So if we're always talking about normalizing, if we have a normalized historical normal multiple benchmarked against the interest rate landscape that we're in right now, which is say 4 to 5%, the multiple should really be closer to 16 than 21 on a forward basis. So you're talking about a market that's what, 40% overvalued. I'm not predicting Armageddon here. I'm not saying you got to run out and go buy, canned tuna and baked beans and sawed-off shotguns and barbed wire. However, I think back to your point, you can get 4.5% earnings yield in the stock market, or as you said, you can get 5.5% yield in the treasury bill market that has no capital risk, and nor does it even have any inflation risk. So I think that's a very good proposition that you just mentioned.
You appear on mainstream financial media channels a lot, and they love to talk about the Fed and Fed policy. It seems like the influence that the Fed has on the markets is a perverse one at the end of the day. You have people keeping track of how many hawkish things did Powell say at this latest meeting, how many dovish things did he say, and almost tallying it up and trying to make a prediction of what's going to happen next. It also seems like the markets tend to react to Fed speak. How should your average investor there think about the Fed, or should they consider it at all when they're making investment decisions?
Well, I think you have to take it into account, obviously, because the most important correlation between treasury yields is the Fed funds rate. The direction of where the Fed is going is the dominant influence on yields out the curve. And that obviously will have an impact on the discount rate and the comparisons you're going to want to make between bond yields and the earnings yield, which I mentioned before. That math hasn't gone away. So the Fed is very important as far as interest rates are concerned, and not just short-term rates, but the impact it has right out the Treasury curve. And the way I look at the Fed is the way I think we should be treating it, like we should all things. You mentioned Charles McKay's book, which is really all about the dangers of following the herd, especially at extremes. So I think we're at an extreme right now, extreme hawkishness at the Fed. And I want people to remember that, Jay Powell became chairman back in early 2018, and it was all guns a-blazing. And he was going to hike rates, and we're going to go through neutral. And neutral back then was 3%, not 2 5/8 where it is today. And then he hikes rates, and of course comes under intense verbal criticism from Donald Trump at the time. He never gets to 3% on the funds rate. I think we got as high as around 2.5%. And next thing you know, he's cutting rates 3 times in 2019, which you could never predicted when he was super duper hawkish in 2018. And he cut rates 3 times, and that was before COVID. And then we get COVID, we get the lockdowns. We think like we're basically in some sort of Armageddon, and people are talking about, we're not going to get a vaccine for 5 years. We're going to be in lockdown mode and pandemic fear mode to perpetuity. Of course, that didn't happen. But at that time, back in 2020 into 2021, I listened to Jay Powell at his testimonies and his speeches. He sounded like a social worker. And the Fed's never going to raise rates again. He was so dovish and stayed dovish for too long. And then the next thing you know, starting in March of 2022, he embarks on the most aggressive Fed tightening cycle for obvious reasons because of the inflation. Most aggressive Fed tightening cycle since the Volcker years in the early 80s. And in fact, he spent most of the rate hiking cycle comparing himself, not to Arthur Burns, not to anybody else except for Paul Volcker. And now the Fed's been on hold. They're dragging their heels, even though inflation's coming down. They're still not confident. Confident is the word that they continue to use. But I think they've stayed too tight for too long, in the mirror image of how they stayed too easy for too long back in 2021 into 2022. So I'm looking at this as an extreme. And the longer they wait, the more they're going to have to cut. The timing is next to impossible to determine. I mean, at the beginning of the year, the futures market pricing in 6 cuts. Now, with all the verbiage coming out of the Fed, that's been consistently hawkish. We're down to barely more than 1 cut, and not till maybe even after the election. Frankly, I don't care. I'm not a market timer. I just know what the destination is. And the longer they wait, the more they're going to have to do. I think that interest rates will end up coming down a lot more than what's priced in. Probably going to be next year's story. And that'll have a downward pull right across the yield curve. And that's why one of my strongest conviction calls isn't actually cash, which I think has got some very nice risk reward attributes right now, obviously. But the greatest potential return for the next 12 months is going to be in the long bond. I think the long bond will generate a total return of more than 20%. And that is out of consensus. But as the Charles Mackay book, the classic from 1841, tells you, and as Bob Farrell's rule number 9, and anybody who doesn't know Bob Farrell, Google Bob Farrell's 10 market rules to remember. He ran equity research at Merrill Lynch for 5 decades. He's like an uncle and mentor to me, and he is a living legend. Rule number 9 is that when all the experts and forecasts agree, something else is going to happen. And what's interesting is that the Bank of America poll of institutional investors was just released a couple of weeks ago, and it showed, and I think these are the numbers, that something like 50, when it came to the question of what's the primary tail risk ahead, something like 59% said an inflation resurgence, and only 23% said recession. And as my friend Jeffrey Gunlock said a couple of weeks ago, which is a great quote, he said, I think those numbers should be reversed. And he's positioned that way. And I'm not going to argue with Jeff Gunlock. I'm positioned that way as well.
And what are your thoughts on gold at this point in time? Obviously, gold hitting new all-time highs. This has caused, at least in nominal terms, has caused a lot of people to become very optimistic. We're seeing a lot of signs, cracks in the economy, out of control government debt, this looming fact that, as you mentioned, the Fed is going to eventually have to cut rates, all seem to be playing into gold's favor. I'm wondering how you see the long-term trend for gold moving forward.
Well, what's interesting about gold is that it's been making new highs in practically every currency, not just the US dollar. This is not a US dollar story. And then you're seeing, periods where commodity prices go down, gold goes up. The US dollar could go up, gold still goes up. Historically, gold would follow the commodity complex. Historically, gold would be inversely correlated with the US dollar. None of those work anymore. And gold is hitting new highs in practically every currency terms. What's it telling you? It's telling you that gold is no longer being viewed as a commodity. It's being viewed as a currency that is no country's liability. And I think the smart money moving into gold is probably thinking that we're at the peak of the economic cycle. Inflation is going to come down, and this is not about inflation. People talk about gold as an inflation hedge. Well, you can argue that the equity market traditionally is an inflation hedge too. It's really about a couple of things. The first is that the Fed will be cutting interest rates. The longer they wait, the more they'll have to do. And there's a time war, and this is one correlation that has not gone away, which is between real interest rates and the price of gold. And real rates will be coming down alongside with either the recession or near recession. And actually, the U.S. economy is already slowed to stall speed. So the interest rate landscape that lies ahead is going to be bullish for gold. But there's some other, global flow of funds developments taking place. And the big breakout in gold actually started, when the White House, froze those Russian assets. And all of a sudden, you have other countries thinking, okay, if this is the weaponry, we're going to use really financial weaponry in these wars, then who's next? And you've got a situation where central banks globally are reallocating their foreign exchange reserves into bullion. And the People's Bank of China is really the poster child in this regard. They have deep pockets, but that's ongoing. That's not going to change. This is actually part of the economic battle that the U.S. is having with China. China is diversifying out of U.S. treasuries, and they are shifting towards gold. And I don't know the day that's going to end, but it's not going to be soon. On top of that, the other fund flow beyond central banks is the retail demand in India. In India, very strong correlation between gold and the Indian economy because people in India love gold. If you've ever seen a wedding dowry in India, it's just chock full of gold. And so the retail demand there is ballooning because India not just has a massive population, but it has 9% GDP growth. They have 9% income growth, and a lot of that income is being spent on gold. And look, this is starting to filter through. There's broader participation. You haven't seen it yet, believe it or not. I mean, the ETF flows have not been that strong. That's what really impresses me is what happens when ETF funds start to see the inflow. And now that you're seeing Costco selling gold bars, that's a sign that, and Costco, the folks running that giant retail operation, they know what they're doing. So there's a lot of reasons. Fund flow, I think that interest rates, of course, when the Fed plays catch down on rates to the rest of the world in the cycle, and we always look at gold in US dollar terms, a weaker dollar will help out, even though I said before that it's not really just against the US dollar, but we price everything still in USD. So I think gold's, if you're going to ask me about a price level, and it's next to impossible to model out, but I am bracing for gold to minimally hit a peak of $3,000 in the next couple of years.
Now, you mentioned central bank buying there, obviously a huge driver when it comes to the gold market. However, I believe institutional investors are still quite underweight gold allocation. You talk to a lot of high net worth individuals, you talk to a lot of people who manage money. What are you seeing in terms of institutions potentially beginning to think about allocating more to the gold space? Is that something that you think could occur moving forward?
Well, I haven't seen it on the institutional side, but I am getting, I've got 3,000 clients across 40 countries. Um, I get most of the questions on the institutional side really about the equity market. But the retail investor, half my clients are what I call retail investors, financial advisors and brokers and private investors. And I'm getting more queries. I'm not getting queries about, like, once I start hearing, where do I buy gold? Where do I buy gold? I'll start to think, okay, now we're getting the whippy sentiment that's going to have me a little bit nervous. So that hasn't happened yet. When that happens, that'll be a contrary sign for me, contrary signal that a lot's priced in. Right now, I'm just getting more questions, really more about where I see gold going. When I start getting questions about, Dave, how can I buy gold? I'll let you know, because that might be a sign to press the pause button.
And when it comes to the commodity space more broadly, when we look at base metals, energy, agriculture, those sorts of things, how do you see commodities set up? I had Grant Williams on the show recently. He said he thinks that right now is the perfect setup for commodities. I'm wondering if you concur, if you're bearish, if you're somewhere in the middle. What's your thoughts?
Well, there's a cyclical element to the commodity complex, and I think that the U.S. is going to go into some sort of recession. I just hope it's not deep, and I hope it's not long. Um, and that'll have an impact on the rest of the world. And we already know that the second biggest economy, China, is flat on its back, dealing with its own debt and property bubble problems. Japan has come out of deflation, but its economy is pretty sluggish. Europe, thankfully, managed to avert another recession, but the economy there is still pretty squishy soft. So I wish I had a strong demand forecast to provide you to get you all whipped up on the commodity outlook, but I don't. However, I think that coming out of the recession, commodities are going to be where you want to have a very high allocation. And because none of us are perfect market timers, you actually even might want to build a position right now because I think that we have such a phenomenally supportive supply curve globally for most commodities. There's just been a chronic lack of investment. It's getting more costly to mine commodities. That includes gold, by the way. That even in a recession, normally you have a recession in commodities. I mean, they could be down, 30 or 40%. That's not going to happen this time. Their cyclical attributes means that commodities, generally speaking, will probably go down, but I don't know if they'll go down that much. And if they do, I think I'd be paying attention because you'd want to be buying that, I think, outside of treasuries ahead of any other asset class. I think that you got very powerful supply side dynamics for virtually every commodity you can think of. And then, even though I'm talking about something cyclical, if you have a longer term view, if you have a 3 or 5 year view or a 10-year view, if you're thinking that I'm going to put some money away for my kids or my grandchildren, the commodity space will be very attractive because the secular trend line for demand, okay, and the recession will provide a deviation from that trend line for a brief period of time. But if we're going to focus on the long term trend line for demand from the commodity sector, it's going to be pretty strong because, when you're taking a look at the future growth of EVs, or you're taking a look at how we're going to fight climate change, if you talk about the amount of resources it's going to take, not just to green the world, but also the power needs that AI requires and all the data centers. And that's why all of a sudden, out of the blue, utilities have started to become a derivative play off the AI boom. I think that, the chip stocks have had their run, and there's a lot priced in, and nobody really knows what the total available market's going to be to begin with. It sort of looks a little bit like fiber optics back in the late 1990s. However, the demand for generative AI is real, even if we have a lot of exuberance in the tech sector already priced in. But what it's going to mean for the demand for commodities writ large, and you're taking a look specifically in energy, it's going to be a very bullish story. So long term, I absolutely agree that we are going into a long term bull market in the resource sector.
I did want to hone in on energy a little bit more there because the oil and gas sector is one that has been left for dead by a lot of funds due to ESG concerns. There's been a lot of underinvestment, but yet energy demands are rising around the globe. As you mentioned, AI being one of the drivers. Obviously, in emerging markets, a new middle class starting to emerge is also a large driver for energy demand. So I'd like to get your thoughts on the oil and gas space moving forward. And I'd also like to lump nuclear energy in there as well, because that is being touted as one of the main solutions. We're seeing governments around the world pivot more and more towards nuclear energy and embrace it where it used to be demonized. Do you watch the nuclear sector and uranium stocks as well? So give us your thoughts on all that.
Or do you mean uranium stock? Okay, so yeah, we've actually written reports on it. It's on our buy list as a sector and has been for the past couple of years. And of course, I don't think there's much of a chance that we can achieve, the clean energy goals with just wind and solar. But you are finding in Europe that the pushback for nuclear is subsiding. I think that will be a trend over time. in North America as well. So we are very bullish on nuclear. And, look, as far as the oil sector is concerned, you're always having to be concerned about the next OPEC meeting. So there's always what are the supply valves going to look like? But the underlying demand for oil, which historically has been very cyclical, is going to be less cyclical and much more structural. So I think that oil prices they may just stay in the current range. I think that the range may drift up. I don't think we're going to $150 on oil like we did back in the summer of '08 when we were all talking about double-digit growth in China to perpetuity and the supercharged commodity cycle. However, I think the one thing I can say about gold, again, looking at the supply and demand backdrop, it has a much firmer floor underneath it than it has in the past. And the oil and gas companies, which admittedly they're out of favor, but you actually want to buy what's out of favor. That's why I love coming back to your initial comment on the Charles Mackay Classic, which is actually up here behind me somewhere, that you want to buy what's out of favor, and you want to buy what's out of favor that has a favorable secular supply backdrop. Forecasting demand, those forecasts are going to change. But when you can see that the supply curve is becoming more inelastic over time, means you have a firmer floor under the underlying price. And then the question is, even if we hit that floor, what are the recurring cash flows and earnings going to be for these oil and gas companies? So I actually think the outlook for the sector is very favorable.
And when it comes to geopolitics, obviously we're seeing a lot of risk emerge around the world. Global conflict seems to be on the rise. New alliances are being formed. There's the whole BRICS versus the West story. How do you factor all of that in when it comes to making investment decisions?
And I think that what it means is that you have to be even more humble in your forecasts than you have in the past. You have to be willing to accept the fact that even your base case forecast or scenario is naturally going to have a wider error term around it than it has in the past, because the world is always an uncertain place, but now we're talking about a level of uncertainty. And whether or not we're in World War III or heading into World War III, we're in a new and totally uncertain environment benchmarked against anything we've seen, certainly in the post-World War II period. What does uncertainty mean? It means that you really have to build scenarios. You have to have a plan B. You can't just have a plan A. If you don't have a plan B, you don't have a plan. So you have to be, I think, more nimble, and you have to be willing to change more than you have in the past. So this isn't about, what sector do I buy? Of course, we've been very bullish on aerospace defense. Of course, I think you have to strip Boeing out of that or find a way to hedge that. But global defense stocks, defense spending is going up everywhere. Even, former pacifist countries like Germany and Japan. You see what's happening in China, maybe only in Canada, but that is an area that has visibility. So you could always say, well, I can construct a portfolio and I want to own cyber, which you probably do, cybersecurity. You want to own, global defense. I think that commodities and gold are generally areas that you think, okay, in global heightened geopolitical tensions. However, I think it means, generally speaking, that comes back to what you said before. You do want to have more cash on hand as an investor than you normally would. That's what higher uncertainty means. Higher uncertainty means that you want to be a little more defensive than you've been in the past. And now that you're getting paid to be in cash, it's not like it's earning you zero. So that's how I look at the heightened geopolitical environment. You want to have cash. You want to have liquidity in the real sense of liquidity. And if you're in a business, you want to be carrying more inventory than you've had in the past. Because then it comes down to how does all this stuff affect supply chains? And look at part of this, if we want to call it World War III, I think some experts on geopolitics would say the World War III has already started. Well, look, all you need is the Houthis, what's happened in the Red Sea. what that's done to disrupt shipping lines. So it means that that you, as a business, insofar as not everybody on the call is just involved in portfolio management, as a business, you have to keep more inventory on hand. And if you're an investor, it does mean you have to keep more cash on hand as well.
Well, David, this has been a fantastic conversation. Thank you so much for coming on. Before I do let you go, could you tell us about Rosenberg Research? Is that the best place for people to go to find more of your work? I know you have a YouTube channel as well. Tell us all about that.
Yeah, YouTube channel, Twitter, um, the regular social media stuff. But if you can just Google Rosenberg Research, it'll take you to the website, and you could peruse it. And if you want to directly contact us, just you can do that at information@rosenbergresearch.com. And one of my client service people will get back to you. And everybody on this call is eligible for a 1 month free trial of everything that I do. So you can kick my tires, taste the smorgasbord, and hopefully you find enough value in it that maybe you'd want to subscribe. But information@rosenbergresearch.com is probably the most efficient way to contact us.
Great. Well, I'll put that in the description below, along with a link to Rosenberg Research website and your social media profiles. David, once again, thank you so much for coming on and sharing your knowledge with the audience.
Well, it was 100% my pleasure.
And thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium. Visit them at arcsgo.com for all of your precious metals needs, and reach out to them by email at ian@arcsgo.com or contact him directly at 307-264-9441, and be sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.